Okay, good morning. Time now 9 a.m. In Tokyo, May 11th, 2022. Welcome to another edition of online seminar by the World Bank and JICA Ogata Sadako Research Institute for Peace and Development. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. Before starting the seminar formally, let me make one small housekeeping announcement about the interpretation in Japanese language. おはようございます。本日のセミナーは同時通訳をオファーしております。この画面の下の方のですね、地球儀のようなマークのクリック、インタープリテーションと書いてあります。これをクリックしていただいて、English というふうにしていただくと英語、そして Japanese というふうにしていただくと日本語の音声をお聞きいただくことができますので、どうぞご活用ください。For Leora and Beniamino and Mahesh, please keep tuning in English channel on the interpretation button, so you will not miss when I introduce a question. If question posted in Japanese language, as I will be reading those questions in Japanese later. Okay, so the World Bank and the JICA Ogata Sadako Research Institute for Peace and Development jointly organize many seminars occasionally featuring the key World Bank publication and during the visit by the authors of those reports to Tokyo in the pre-COVID time. And we are continuing our joint collaboration in a virtual format in the current circumstances. In fact, this is the third online seminar we co-organized. Last year in July, we featured the World Development Report 2021 edition, which was about data. And in December seminar last year, we featured At Your Service report. We are very much thankful to the JICA, the Ogata Sadako Research Institute for continued opportunity to collaborate in sharing knowledge and views on the global development issues. Thank you very much. The World Development Report, or WDR, is the World Bank's flagship report published annually. Each time, WDR has a special topic, and the team offers very deep analysis on challenges and frameworks for policy action on respective topics. This morning, we are featuring the World Development Report 2022 edition, subtitled Finance for an Equitable Recovery. The report was released in February 22nd this year. And once again, we are very much thankful to be able to introduce the WDR latest edition featuring the team in charge of the report for the stakeholders and audience in Japan. We have very distinguished speakers and commentators this morning. Let me introduce very briefly each one of them. First, we have Leora Klapper, the director of the WDR 2022, who is a lead economist in the finance and private sector research team at the Development Economics Vice Presidency called DEC. Leora, good evening, good morning to you.
Good morning.
Great, thank you very much. We have also Beniamino Savonitto, who is the economist in the Sector Economics and Development Impact Department of the International Finance Corporation, IFC, of the World Bank Group. Beniamino, good evening, good morning to you.
Good morning, everyone.
Great, thank you very much. And we have also Mahesh Uttamchandani, who is a practice manager for finance, inclusion, and infrastructure at the Finance Competitiveness and Innovation Global Practice of the World Bank. Mahesh, good evening, good morning to you.
Good morning, and thank you for having us.
Great, thank you very much. From the Tokyo side, we have two distinguished commentators. First, we have Professor Naoyuki Yoshino, the Professor Emeritus of Keio University and the Director of the Financial Research Center at Financial Service Agency of Japan. Professor Yoshino, good morning to you. Thank you very much for joining. You are muted.
Thank you for inviting me today. Thank you.
Thank you very much. And then on behalf of the JICA Ogata Research Institute, we have Tetsuya Harada, who is the Executive Senior Research Fellow of the Institute. Harada-san, thanks for joining us this morning.
Thank you, and good morning.
Great, thank you very much. So we have very distinguished speakers and panelists this morning with us. So for the first 40 minutes, we'll listen to Leora, Beniamino, and Mahesh presenting the main findings of the WDL 2022. Then we'll listen to Professor Yoshino and Harada-san sharing their comment on the report. If you have questions to speakers or if you have points to make, please post your question and comment on the Q&A section on the Zoom screen. You can post your question and comment in English or even in Japanese. I'll read your question and comment during the Q&A time later during the seminar, asking the speakers to respond. With that, I would like to ask Leora to lead the keynote presentation. Leora, over to you.
Thank you. Can you see my screen?
Yes.
Okay. So thank you again for this opportunity to present the 2022 World Development Report, Finance for an Equitable Recovery, which we launched in February of this year. The report was drafted by an interdisciplinary team from both the World Bank and International Finance Corporation, the IFC. We hope that our report will elevate these issues among government priorities during the recovery. So to summarize, our report focuses on the unprecedented financial and economic risks that have been created or worsened by the pandemic and the pandemic response, and outlines concrete steps that policymakers can take to address them. The global public health crisis that was triggered by the pandemic quickly led to an economic crisis, which has increased global poverty and inequality. In 2020, economic activity contracted in 90% of countries. The world economy shrank by about 3%, and global poverty increased for the first time in a generation. While the wealthiest 40% of the global population continued to recover, the income of the poorest adults is expected to continue to decline. And even as countries around the world were struggling to contain the spread of COVID-19 and manage the health costs of the pandemic, governments are quickly implementing an encompassing and unprecedented response of fiscal, monetary, and financial sector policies, all aimed at limiting the worst immediate economic impacts of the health crisis on households and businesses. So we collected data showing that these included direct cash transfers, debt repayment moratoria, as well as central bank unconventional monetary policy, such as asset purchase programs to pump liquidity into the financial sector, which were used by 27 emerging markets for the first time during the pandemic. For example, early in the crisis, the Philippines took 22 measures to support the banking sector, 11 to improve liquidity and funding, and 6 to support the payment system. In the midst of the crisis, these policy measures provided much needed liquidity support to households and helped avert a wave of loan defaults that could have threatened the stability of the financial sector. However, policymakers around the world now find themselves trying to achieve a balance between providing enough support to prevent the worst human costs of the crisis while limiting the longer-term risks, especially to debt and credit risk transparency that may result from the unprecedented crisis response, like the regulatory forbearance and delayed credit reporting, which can hide banks' true asset quality, and increases in sovereign debt, including hidden debt, to finance support programs. Our conceptual framework illustrates the central message of this report, that the numerous mutually reinforcing channels that connect the financial health of households, firms, financial institutions, and governments could trigger a global financial chain reaction. This means that elevated financial risks in one sector can spill over and destabilize the entire economy. So to give some simple examples, inclusive access to financial services offers households and businesses financial resilience to economic shocks and unanticipated expenses that many are experiencing, and allow firms to invest in the recovery. The banks confronting a decline in loan quality tend to tighten their lending, and those reductions typically hit lower income households and smaller businesses the hardest, setting up a negative feedback loop between financial sector performance and real economic activity, the potential to increase income inequality. Official statistics seem to show that the private sector is in good health. Non-performing loans and bankruptcy rates are typically flat. But a lot of distressed and over-indebted assets remain hidden, thanks to all the forbearance policies that are put in place, and they're only now coming into view. and there's reason to be worried. For example, even before the COVID-19 pandemic began wreaking havoc on the incomes of lower-income households and businesses, global household debt had increased by more than 30% as a share of GDP since 2008. And household balance sheet data show that in low and middle income countries, only half of all households had the liquidity to sustain basic consumption beyond 3 months. Recent surveys of businesses in developing countries during the pandemic found that 46% expected to fall into arrears. And business performance also seems to have been affected, showing, for example, data from the MasterCard Economic Institute tells a contradictory story. Globally, business failure rates doubled in 2020 above the 2019 and 2018 baselines. In Japan, rising food and energy costs, coupled with a falling yen that's hit a 20-year low against the dollar, are adding additional challenges to the economy struggling to emerge from the pandemic. Loan defaults could now sharply increase, and private debts could quickly become public debt as governments are forced into bailouts. Households and firms suffering from lower income and revenue also pay less in taxes. In addition, when the financial position of the public sector deteriorates from higher debt and debt servicing, this may weaken the government's ability to support households and firms. We also discussed global risks, such as rising interest rates and inflation risk, which, as Augustine Carsons explained nicely in a speech last year on central banks and inequality, inflation is a regressive tax that disproportionately hits the most disadvantaged because the poor see their wages erode, but typically don't have inflation-resilient assets to hedge this risk. And therefore, the responsibility of central banks' macro stabilization role can help make an equitable society. The policy challenge going forward will be to ensure sustainable debt burdens and uninterrupted access to formal credit, so that first, household and businesses, especially low-income households and small businesses, maintain access to financial services that offer financial resilience to economic shocks and allow firms to invest in their recovery. And second, governments and financial institutions can support the recovery and provide adequate financing, including for investments in all the services governments need to support, such as education and health. Our report focuses on 4 priority areas and policy measures that government should take now to avoid major financial upheaval. First, increasing transparency, reducing the share of non-performing loans to ensure that banks can continue to lend. Second, to ensure effective procedures to discard distressed debt, including out-of-court mediation and conciliation, which is especially beneficial to smaller businesses and individuals. Third, to ensure continued access to credit. And fourth, to manage sovereign debt sustainability. So the first area for policy action we discussed in the report is the need to address risks to financial stability arising from the pandemic to ensure that banks can continue to lend to support the recovery. The pandemic has created risks to financial stability, not only because of the dramatic loss of income and business revenue, but also because some aspects of the policy response have led to deterioration in credit market transparency. Debt moratoria, regulatory forbearance, freezes in credit reporting, introduced to prevent the wave of loan defaults, may also reduce credit market transparency. And this opaqueness has complicated the task of lenders of distinguishing between viable businesses with temporary liquidity problems and non-viable borrowers. For example, as shown here, more than 40% of surveyed businesses on average expected to be in arrears within 6 months, including over 60% of businesses in Turkey. Against this background, one of the main recommendations of the report is that problem assets must be recognized and dealt with promptly. The faster non-performing loans are addressed, the sooner banks and microfinance lenders will be able to support the recovery. The timely management of non-performing loans is important for 3 main reasons. First, high NPL levels burden all throughout all sectors in the economy. So research shows that delayed action can cut off access to credit, destroy jobs, and discourage entrepreneurship. Second, high NPLs depress economic growth, as for example, the well-documented case of Japan's lost decade of growth. Third, without swift policy responses to hidden loan distress, we could also see an increase in evergreening, the continuous rolling over of zombie loans to businesses that are weak, with little or no chance of returning to health, and politicized government interference in debt resolution. This ultimately translates into lower economic output, investment, and employment. But the negative cycle of high NPLs leading to low economic growth is not inevitable. establishing an effective NPL resolution strategy that involves regulatory authorities and the private sector as an urgent priority. And there are many benefits of early and decisive action. First, unambiguous regulation to identify NPLs allows lenders and regulators to assess the magnitude of the issue and take prompt action. Second, building banks' operational capacity to deal with a significant increase in NPLs improves the efficient resolution of distressed assets and frees up resources for credit intermediation. Third, authorities should be prepared to quickly assist troubled banks, while always prioritizing and exhausting private sector-led and funded solutions before resorting to bailouts. Experience shows that taking action allows non-performing loans to be brought to sustainable levels. For example, in the report, we highlight various examples of countries that have successfully equipped their financial sector to address rising levels of non-performing loans. Here we show how Serbia, which established a national NPL working group to reduce stubbornly high levels of NPLs in the aftermath of the 2007 to 2009 global financial crisis, managed to bring down their NPLs before 2020 and was in better shape going into the pandemic. Let me now turn the floor to Mahesh to discuss the delayed resolution of distressed loans.
Thank you very much, Leora. So we know that there were in a significant number of countries, businesses reported that they were likely or expecting to fall into arrears within the next 6 months. And this presents the challenge of distressed loans to financial institutions. And that challenge presents a significant risk if that resolution is delayed. We know from a significant amount of evidence that if that resolution is delayed, it can slow the recovery by inhibiting the availability of new credit to those firms that are healthy and that want to grow. Can we go to the next slide? And so the key policy priorities are to strengthen formal insolvency mechanisms, which help resolve and clean out non-performing loans through dealing with distressed businesses, but also facilitating alternative dispute resolution systems such as conciliation and mediation, which provide a more consensus-driven and lower cost resolution of distressed firms. Establishing accessible and inexpensive in-court and out-of-court debt resolution processes, specifically for micro, small, and medium enterprises, and promoting debt forgiveness and discharge of natural person debtors. Next slide. Now, in looking at some examples of how countries have handled the challenge of rising NPLs, we saw that Poland's Act of Financial Restructuring of both enterprises and banks allowed for the development of conciliation agreements between debtors and creditors and allowed creditors to divest NPLs on the secondary market, which allowed banks to receive an influx of capital to facilitate the restructuring process. By mid-1995, about 85% of the conciliation agreements had been finalized, and they included debt write-offs, extensions of payment periods, more favorable debt terms, and debt for equity swaps. And this resulted, we believe, in NPL rates falling from 31% in 1993 to 9% in 1996. Now, sorry, next slide.
I seem to be missing. I'm sorry. Apologies. Next slide. Yeah. You're welcome to continue.
No, I think we finished with this slide.
Okay. So thank you. Benny, would you like to continue around tighter access to credit?
Sorry, Benny, just to make one more point, apologies. One of the things that was observed both at the start of the crisis, but even going into this crisis, was the inability of traditional debt resolution mechanisms to speak to the challenge of micro, small, and medium enterprises. And so the report recommends specific systems tailored towards these enterprises that would allow for a cheaper and faster resolution, recognizing that traditionally complex restructuring mechanisms, such as in the US Chapter 11, or such as Japan's very robust debt restructuring framework, may not work for these smaller businesses that are often single owner owned and operated and have very, very simple capital structures that may not warrant the full suite of tools that are available under a traditional restructuring practice. And so we've seen throughout the pandemic, a number of countries, particularly in East Asia, adopt these faster and simpler mechanisms for SME insolvency. Sorry, Benny, over to you.
Thank you.
Thank you. So far we've heard about the need to address outstanding credit, to resolve balance sheet challenges for banks, and to move to the efficient resolution of distressed assets. But what we focus here in the next few slides is actually how studying the effect of the crisis on the ability of economies to generate new risk. The lockdown had a severe impact on economic activity, as we can see from this graph, and heightened credit risk by doing two things mostly. It significantly impaired the visibility the lenders have on borrowers' capacity to and willingness to repay loans, and limited lenders' option for recourse in the case of default from borrowers. The chart here represents data from 38 countries, from loan officer surveys from 38 countries, and shows a clear dip in credit standards, a tightening by financial institutions across these markets in the first quarter of the crisis. And while in 2021, the situation started to balance out with more firms, more lenders across countries returning to easier credit standards, we're actually seeing already in the beginning of this year some of the emerging data showing a return to tightening because of the current conditions in Europe and globally. Leora, next slide, please. So this is just kind of an extract of the previous slide showing some of the data from the East Asia Pacific region that we see. Of course, this is, I think, a good illustration on how every country ultimately was different. But most impressive here, you see the tightening of financial institutions in the Philippines and Indonesia as well, while Japan maintained favorable credit conditions and standards, even improved them slightly through the crisis. Next slide. So I want to complement that kind of the central bank available data on credit standards with some insights from a recent survey that I and other colleagues have completed of financial institutions clients of IFC. We surveyed a sample of nearly 200 lenders across emerging markets twice, once at the end of 2020 and now and most recently at the end of 2021, to show how financial institutions were impacted and how they recovered or begun to recover from the crisis. And indeed, in 2021, we do see very strong signs of recovery. We see that while collection levels were still a challenge for a majority of lenders and Npls increased, they did so at what is seemingly a manageable amount, and the outlook by and large was positive, both for operations as well as for portfolios of these institutions. So here I just summarize some of the data. I should, however, point out two aspects, and I won't go through the data in this slide, but show two aspects. One, that low and lower middle income markets were both more heavily affected in 2020 and also lag behind as of the end of 2021 in terms of most metrics. One example, 2/3 had collection levels below pre-crisis in low and lower middle income markets versus 1/3 of respondents in upper middle income and high income markets. One other key point to highlight, and it's the one here at the bottom of the slide, 46% of financial institutions as of November, December 2021 still said to us that they had tighter credit standards for micro, small, and medium enterprises compared to how they would consider lending to those borrowers before COVID. Asia, particularly the East Asia Pacific region, is one of the regions that has been and continues to be most affected by the crisis. Just by a way of comparison, while we see a 46% across all 200 institutions, the institutions we interviewed from the East Asia Pacific region, among those 68% had tighter credit standards for MSMEs. So clearly, tighter credit conditions that derived from a riskier outlook for businesses and the impact of the lockdowns on ultimately the balance sheet of these businesses continue to be quite widespread. And unfortunately, the outlook that these lenders have shared with us did not, and this was before the Omicron crisis, before the rise in interest rates and inflations that we have seen in the last quarters, and of course before the Russia-Ukraine conflict. They were not expecting to ease credit conditions for MSMEs. This essentially shows that there might be a while before MSMEs will find an easier way of accessing credit than they currently are meeting. To point out again the effect of visibility and recourse here, the difficulty, it's not only about the riskiness of the outlook, but also the difficulty that lenders have in understanding what is the risk of the borrower, as well as on the side of recourse that I mentioned earlier, the quality of collateral has weakened for most borrowers, particularly in this segment of the micro, small, and medium enterprises. Ultimately, more conservative lending standards means that even households and entrepreneurs that would have otherwise been able to repay a loan and could have actually put it to good use in terms of participating in the recovery and rebuilding their businesses are significantly less likely to have access to credit. Next slide, Leora. Thank you. Yeah, so in the report we shift. We don't only present the risks, but we also try to present some of the opportunities that have emerged from this crisis. And there's one particularly important silver lining, which is through this crisis, all available data shows that there has been a digital dividend produced, meaning we find from business surveys and industry data that there was a large growth in adoption of technology by businesses and by consumers as a result of the crisis, motivated by the lockdowns, but not only. And the available data on payments and technology adoption, both by consumers, but also by financial institutions, point to an acceleration in the pace of digitization. Importantly, the same survey I mentioned earlier also shows that digitization is, by and large, and digital transformation is the priority for the majority of financial institutions across emerging markets, even today. So this table summarizes some of the strategies that we outline in the WDR that lenders can adopt to continue lending in spite of the heightened risk and uncertainty that they're facing. Some examples include the use of alternative data to improve visibility to current borrower conditions, securing credit, and ultimately linking the credit to the underlying economic activities. This is the embedded finance and supply chain finance that are product offerings that are emerging quite rapidly in the landscape today. Now, some of these solutions are not new, but a number of them, most of them, dare say, are further enabled by this growth in digitalization, and that's what we explore in the WDR. One point to note regarding data is, again, to refer back to the survey I was mentioning, we find that 60% of institutions had made significant updates to their credit models following the crisis, yet only 1 out of 7, so 14%, added capabilities to integrate alternative data or machine learning and risk assessments. So the adoption of technology continues to remain a barrier for many of these lenders. Next, Leora. Yeah, so this is an example actually from leveraging data from the Polish Credit Bureau that shows the impact of the crisis on not only the demand for consumer lending that dropped following the crisis, but in this case, it shows how lenders reacted by significantly tightening credit conditions. And you see the dip in cash loans, in approval rates for cash loans was quite significant and lasted over several quarters. what we do see, and this is an example of how product designs can actually help tackle some of this issue of visibility. We see that for the installment products that allow for a higher visibility on the lender's capacity and ability to pay, for those products, approval rates remain, significantly more constant or stable compared to cash lending. 2 more slides. Leora, if you can move to the next example. So another example here that we feature in more detail in the WDR is the case of My Bank in China. This is a strong demonstration again on how technology applied to risk underwriting and applied to the integration of payments and commerce data with the activity of a lender has helped reach a large number of MSMEs during a period that was certainly challenging for lenders also in China, while maintaining limited NPLs. So this is certainly an interesting case study for the application of technology. Another example here, always related to the My Bank, is how this digital lender essentially was able to partner with incumbent financial institutions to offer the financing and scale to reach 40 million MSEs as of 2021, MSEs being micro and small enterprises. Final slide. So policy priorities for policymakers that we highlight are this importance of enabling responsible lending innovation. And these enablers can include policies around data access. And of course, this data doesn't have to be alternative data necessarily. Access to traditional credit information is still lacking in many emerging markets and would be very important to address this gap in visibility that currently lenders face. While at the same time, including consumer protection and privacy guardrails in the adoption and the usage of this data. Another element that is important is the support of innovations in products and in risk management. And that can also be done through investments in financial infrastructure, ranging from upgraded payment system to asset registries and frameworks for secure transactions. And then maybe the last point that I raise is the importance for policymakers to enable new providers, such as data-driven digital lenders like the ones that we saw earlier, and embedded finance providers to enter the market to allow this innovation and to demonstrate essentially new ways of assessing risk and reaching particularly micro, small, and medium enterprises. Thank you, Leora.
Thank you very much, Mahesh and Benny. So throughout the World Development Report, we also include spotlights, which are really focusing on development finance. That's including a discussion on the relationship between financial inclusion and financial resilience, looking at specifically around how to support the microfinance sector, which typically funds and supports the bottom of the pyramid, the poorest households, micro enterprises, through regulation and supervision. Also, MFIs often facing their own challenges on refinancing their own funding needs. In many cases, microfinance institutions do not take deposits and therefore depending on the market. We also discuss the role of specifically targeted and well-contained and well-regulated public credit guarantees to support micro and small businesses to help them mitigate the risks of moral hazards and how to avoid the politicization of these guarantees. We also discuss the importance of strong financial markets to accelerate the transformation towards a more sustainable world economy. We give examples of how regulators can incentivize green investments, such as mandating higher risk provisioning for loans to sectors engaged in non-sustainable activities. We also discuss the role of capital markets and how the economic stress arising from the pandemic has propelled the expansion of sovereign sustainable bond issuances. Now, although there's no conclusive cross-country patterns, at least some sovereign green and social bond issuances have paved the way for similar debt issuances by the private sector. So for example, we bring some suggestive examples of how government issuances could crowd in private bank issuances, including, for example, in Chile, who in 2019 became the first country in Latin America to issue a green sovereign bond. And soon after, a large private bank issued a green bond to raise funds for renewable energy projects. And finally, the fourth chapter addresses that in many countries, the crisis has really exasperated and exposed deteriorating sovereign debt quality. And as shown in the left, the dropping government revenue might pose a risk to banks through their high bank exposures to government debt. We show here on the right, really the growing government debt in 2020 as countries supported large number of transfer programs and other support programs. And that now are facing additional in many countries military expenses and other government debt costs. And so these countries should prioritize our guidance on how the existing debt burdens can be managed more effectively. So as to free up resources to support the recovery and avoid or mitigate the significant social and economic costs of sovereign debt distress, which are associated with an assortment of economic problems, ranging from prolonged recessions to high inflation, which can have these disproportionate negative effects on the poor. And the figure on the right is from research by Carmen Reinhardt and others, showing that it takes on average 8 years for countries to emerge from a sovereign debt default. And so finally, our policy priorities, effective debt management requires increased debt transparency, full disclosure of claims and contract terms, contractual innovations such as collective action clauses and insurance for borrowers against natural and climate-related disasters, and appropriate revenue mobilization through sound tax policies that also strengthen incentives for business to formalize. And so thank you again for this opportunity to present. I hope you'll dig in yourself to the report's finding and our gratitude in advance to our two discussants. So thank you.
Thank you very much, Leora, Mahesh, and Beniamino for your keynote presentation summarizing the main findings of the latest edition of the World Development Report 2022 edition. Thank you very much. Before inviting the commentators, let me mention that the PowerPoint, which was just shown by Leora, has been posted on the World Bank Tokyo office website, and then later to be posted on the JICA website also. So please take advantage of it. It's already posted in the World Bank Tokyo office website, the seminar announcement page for this WDR seminar. And also, I would like to encourage everyone to post your questions in English or in Japanese on the Q&A section on the Zoom screen. So I'll read your question later during the Q&A section of the seminar. So we have two distinguished speakers from the Tokyo side. Let us first invite Professor Naoyuki Yoshino, the Professor Emeritus of Keio University and Director of the Finance Research Center at the Financial Services Agency of Japan, sharing his comment for the next 10 minutes. Yoshino Sensei, please.
Okay, thank you very much for inviting me. I would like to post my comments. Can you see my slide? Thank you. It's an excellent paper and very timely paper. And I think that paper addresses all the common items to be needed in many countries. And I think one more report will be needed to specify for each country, because country by country may have different environments. So I'd like to comment based on Japanese experience, and that may apply to some of the countries. And these 4 points are well taken and very important. But one of my first question is reducing loan distress, and number 3, continued access to finance. These two together is sometimes very difficult, especially for SMEs. So how to screen relatively good SME and not so good SME. And as you mentioned, transparency of the data analysis will be important. But first, my question is how to reduce loan distress, at the same time, how to continue access to finance, especially MSMEs. Do you have any specific ideas to do it? So that is number one. Second one is a credit guarantee has been extensively used in Japan in order to support SME credit from banks, together with transfer from the government to private sector and manufacturing. And this credit guarantee scheme has reduced Japanese non-performing loans. That is the second diagram. And top diagram is the amount of credit guarantee. So you can see in Japan, after the COVID-19, credit guarantee expanded almost twice. And at the same time, non-performing loans has reduced remarkably because these credit guarantees were 100% guarantee by the government. So it looks like banks are doing very well only for looking at this diagram. However, there are two, excuse me, this does not go ahead. Okay, excuse me, thank you. There are two kinds of SMEs. One is temporarily affected by COVID-19, and another one is structurally problem. And how do we differentiate between these two MSMEs? In Japanese case, because of credit guarantee, both of them are supported. And that was also supported by politicians. Banks should keep on lending money to MSMEs. And it is very important to look at the data of these two kinds of SMEs, whether they are continuously in deficits or whether they are temporarily in deficits. So prior to COVID-19, whether those SMEs has positive profits or not. So those kind of data is important to clarify temporarily affected SMEs and structural problem. And these two has to be clearly differentiated. And as for the non-performing loan problems, when I looked at the Japanese banking industries, I was the policy board member of the Deposit Insurance Corporation of Japan about 20 years during this crisis after the Japan's asset purchase bubble. And about 180 banks went into bankrupt. And non-performing loans in Japan are categorized into 4 items. One is real estate housing related default. Second one is concentration of certain sectors, and rather than distributing to various SMEs. Third one is the depression of local economy. Fourth one is failure in stock and bond securities investment. And last one is the fraud. So those were the 4 reasons why non-performing loans increased in Japan. So when you discuss about to avoid NPL, you have to be very careful what kind of NPL we will be talking about. And then as for the transmission mechanism of financial distress, I use the flow of funds table to look at various impacts. This is a published paper, which is in the reference. I looked at the Korean case by looking at the bank failure, how it will affect to government sector, households, firms, and so on. And in order to do so, we need flow of funds table. So your presentation about spillover effects and external effects, that could be, if the country has a good flow of funds table, that can be captured by its connections. And bank resolution schemes, I think many developed countries has already established. And I wonder these kind of bank resolution schemes can be applicable to developing countries or not. So that is another question. First one is early warning system. In Japanese case, financial service agencies monitors each bank, or central bank monitors each bank. Then if the bank has problem, number 2, separate good loans and non-performing loans. And non-performing loans are brought to RCC. And good loans will be absorbed by another good bank or bridge bank, and the business will continue. And then number 5, criminal investigation about those non-performing loans. Then number 6, capital injection by Deposit Insurance Corporation. And as it is pointed out, it has been disclosed. So in Japanese case, how much capital had been injected to each bank has been disclosed, and it became transparent. So when the bank recovered, they started to return these injected capital. And in Japan, almost all the banks except one has returned all these borrowed money from Deposit Insurance Corporation. So this is the stylized scheme in many developed countries. So is there any additional points for the developing countries, or is this the correct scheme for it? And next one is the role of the bank, especially for MSMEs. In Japanese financial service agencies developed in these several years, in the past, banks are just standing up and watching SMEs. But number 1, banks has to do together with those MSMEs. Number 3, work together to recover their assets and so on, and how to improve their businesses. One of the examples in Japan is there's a tatami mat in Japanese household, and they are not sold very well. Then online sales was advised by the bank. Then this small business started to advertise their tatami mat to all over the world. Then from the Britain and Paris, there are lots of demands came to that small business, and they are now exporting their products. So those kind of assistance by the bank. So banks has to work together and go together with SMEs. So those are very important lessons for other countries. So banks has to help each SMEs to recover and how to improve their sales. That is also the role of banks, rather than just computing non-performing loans. And next point is about the asset price inflation. I wonder whether too easy monetary policy would have been affected housing price or property price in developing countries. So this is a case of Japan and US of the house price divided by income. Then Japanese case, bubble increased. Lehman shock, USA has increased significantly. And currently Japanese condominiums prices are rising very rapidly. So I'm a little bit concerned about Japanese asset price inflation caused by very easy monetary policy. So I wonder whether this will apply to developing countries or not. And this is Hong Kong's case. And as we every know, last year, there's a big crash of this housing market in Hong Kong and China. And why this asset price inflation will occur compared to other sectors? These housing and real estate market, banks can lend money, both suppliers and purchasers. If the rate of interest is very low, they can encourage construction companies to construct housing and real estate. And then they can also lend money to borrowers. So I think this is a very unique sector. That's why we often observe bubbles. In other sectors, we cannot lend money to both demand and supply. That's why in properties market, we often observe bubbles. Last one is the fiscal sustainability. And DOMA condition is very famous. And then many reports says interest rate and growth rate of the economy should be compared. And this equation is obtained from supply of government bonds. So in US case, this applies because demand for bonds comes from all over the world. So Professor Doma's condition is correct to the case of United States. But all other countries, we are facing with the demand. Left-hand side is the case of Japan, right-hand side is Greece. Greece went into bankrupt, Japan is still sustained. The major reason is whether the demand is coming from domestic market and stable, or it comes from foreign market. And Greece case, 2/3 of their borrowers came from overseas. Japanese case, only 5%, currently 10% are overseas investors. So demand side is very different. On the right-hand side, Greece, left-hand side, Japan. Demand was continuously increasing to the right and shifted. In Greece case, foreign investors flew away from Greece. So that increased its interest rate. Japanese case is interest rate is always very low. So blue line is a case of Greece, and bottom black line is a case of Japan. So the final point is we have to look at the demand and supply both together in order to look at the debt sustainability. And last point, which I didn't put here, is I think it is important to look at the green bond and especially sustainable bond. There are many different kinds of green bonds. Some green bond, 90% green, 10% gray. And another green bond is 70% green, 30% gray. There are so many different kinds of green bonds when they construct solar energy, wind power, and so on. But currently, all those green bonds are sold single and uniquely. So I think credit rating of green bond will be very important in order to screen the quality of the green bond. The report was very timely, and I think based on Japanese case, each developing country has to pay attention to their own economy and also to absorb your report and then congest the report a little bit for their application to their country. Thank you very much. That's all my presentation.
Thank you, Professor Yoshino, for sharing your comment on the WDR 2022. I'm sure the team is already ready to respond to your comment. But before asking the team to come in, I would like to ask our second commentator, Mr. Tetsuji Harada, Executive Senior Research Fellow of the JICA Ogata Sadako Research Institute for the Peace and Development, sharing his comment for the next 10 minutes. Harada-san, please.
Okay, thank you. My name is Tetsuya Harada from JICA, Japan International Cooperation Agency, and I'm honored to make comments on this very important World Bank report. And first of all, I would like to express my respect to the bank team writing and publishing this report in this critical timing. I'm a senior researcher at the Ogata Research Institute of JICA, and previously I have been involved in various risk management tasks, including sovereign risk assessment for JICA's loan operations. So from this standpoint, I'd like to make several comments and questions. Okay, main points of the report. I want to explain this in detail because of the time limitation, but my major takeaway is these 3 points. And I will make comments one by one, but let me say that my comments would cover not just the main presentation of today, but some other part of the report, because the report is very rich in context, in content. So the report provides a very important look back of the COVID-19 crisis. And I would say that when we analyze the impact of the COVID-19, the magnitude of the initial shock tends to be emphasized. But I would say that it's also important to see which period over the past 2 years is analyzed, because there are a lot of heterogeneity of recovery processes and resilience across countries and issues. So, for example, our JICA Institute have researched workers' remittance to home countries. The workers' remittance is 3 times more than the official development assistance, so it's a very important financial source. And that financial flow dropped substantially for first several months of the COVID-19 crisis, but then it recovered relatively quickly and helped the families of their home countries. So it is sometimes said like a sort of surprise or mystery. So it's very meaningful to continue analyzing how different the recovery process are among countries and among some different issues to make a very good policy input for the governments. second point is about the interconnected financial risks. So this is also very, I mean, this is the main part of this today's presentation, and this is very important agenda. Then it's very important to shed a light on this because so far this issue hasn't been discussed well. And then report particularly highlights the risks of firms and banks. But I would say that now it seems that more risks are coming from the sovereign side. For example, if we see, for example, the announcement of the default by Sri Lankan government, so it's also important to look at the reverse side from sovereign to firm or sovereign to the banking sector. Here I write the sovereign bank nexus, which means that many governments of the emerging countries have issued sovereign bonds to conduct expansion policies, and many domestic banks have increased their holdings of sovereign banks, and then now sovereign bonds are under difficult situation in many countries, so it would affect the quality of assets of banks. So here my question is rather simple. I think this report was released before the war in Ukraine. So the impact of the war is really severe, and it's called like a crisis upon crisis. So many countries are now under even more challenging situation with higher prices, food, fuel, and financial outflows. So in reality, it should be very difficult to make a good balance between preventing economic downturn and then maintaining the health of the financial sector. So considering the Ukrainian crisis, do you think that some adjustment is necessary in terms of the message of the report, or is it about the same? So how realistically it is in both political and economic context to address those issues like you mentioned, like rising NPLs? And then this leads me to the third point of the report, my comment, sovereign debt. Let me here focus on debt transparency. We know that the bank has worked very hard on this issue, and we really appreciate it. And I also would like to mention that there have been a significant positive move about the debt statistics of the bank for DSSA eligible countries, debt service suspension initiatives. DSSI stands for. A lot of progress are made and for their debt information. And we hope that this detailed information by the World Bank can be a standard of the international debt statistics, not just for DSSI country, but for other countries as well. So a lot of progress is made in debt transparency, but frankly speaking, uncertainty still persists. Like debt transparency of non-Paris Club countries are still a serious concern. Some debts are not reported correctly, or another report of the bank published last November about debt transparency suggests that about like 10% of the recent borrowing of sub-Saharan African countries are so-called collateralized, meaning that the future revenue of a particular commodity or some country's asset are set aside for the repayment of to a particular creditor. So a lot of things need to be done to improve the visibility of sovereign debt. So here my question is about the World Bank's debt reporting system. I think the bank required each member country to report their debt information. And if some debts are not reported correctly or some debts are collateralized, isn't it already be a sort of a violation of the requirement as a member country of the bank? So in such a case, do you think that the bank can make some sort of like punitive measures? And by such a way, can the bank demand further disclosure of loan information to member countries? Or is it more challenging and it's not so straightforward in reality? So let me stop here. And again, thank you very much for today's opportunity.
Thank you very much, Harada-san, for sharing your comment. And I would like to really deeply apologize that I kept mispronouncing your first name. Sorry about that. So let me invite Leora and the Beniamino and Mahesh to respond to the comment just made by Professor Yoshino and Harada-san. So I would like to ask Leora to navigate making responses to the commentators. Thank you.
Thank you, and our sincere thanks for both of these really excellent comments, which helps frame our report also in the current situation. Certainly the war in Ukraine, which happened after our report was published. But we hope its lessons are applicable to changing situation. I'll keep my remarks short because we have some interesting questions in the Q&A. It would be nice to get to. So both comments really honed in on the main messages of our report, which is the microeconomic impacts of macroeconomic shocks, which we often don't talk enough about. So in other words, what are the effects on businesses and households of, for example, unsustainable sovereign debt, which in many countries continues to grow as a result of potentially necessary subsidies or tax breaks as a result of rising food and fuel prices, or for example, for necessary funding for military support. And one of the, I think, messages is that we also actually need better data on household balance sheets. So for example, you mentioned the important role of remittances on resilience. Certainly the speculation that a lot of that is coming out of the savings of the workers overseas, that workers dipped into their own savings towards their own savings goals in order to send more money home to send to family suffering under COVID. And as we've been discussing, this, the additional burden, for example, on bank balance sheet of holding sovereign debt, which might be deteriorating quality of sovereign debt, can affect the role of credit as a form of resilience. Regarding the role of credit guarantees, it's a very interesting slide around Japan, and again highlights the importance of understanding what is going to be the effect of looking forward, being forward-looking around the impact of the lifting of these guarantees and how that can affect bank quality and bank's ability to lend. And one of the last things, you made a really important comment that with interest rates increasing to control inflation, the rule that growth rates are larger than the interest rate may stop holding for some countries. And that this is an especially high risk for countries with high levels of debt. And again, another important risk for countries to be aware of and to manage. Thank you. Mahesh or Benny, would you like to add anything?
Just a note on asset sales and asset reconstruction companies. I think it's important to recognize that in the end, these have rarely proven, at least in past crises, to be a sort of silver bullet or solution to significant rises in NPLs, partly because the transfer price of these non-performing assets are determined by the resolution mechanism. In other words, what can be recovered under the resolution mechanism. Otherwise, ultimately what happens is that the financial institution has to recognize a loss and possibly be recapitalized, or there has to be a subsidy coming from the government in the form of the asset purchase. So while they can be administratively useful, and they can, certainly in the case of a recapitalization, clean up the balance sheet of banks that have a lot of impaired assets, they're not a solution to the underlying problem of these high levels of distress.
Leora, if I may just add a point, again, an interesting point on the government securities. Yes, we do, for example, see in the survey that I mentioned, about a 15% increase in exposure across the financial institutions we surveyed in terms of exposure to government debt. And then on the guarantees, I think the guarantees have this, and it was highlighted in the comment, they increase recourse, but they can potentially impair visibility and ultimately misallocate resources. And there's emerging literature that shows or that would indicate that guarantees are actually not as efficient as we might hope, and might still be steering most of the guarantee towards firms that don't actually need it. So there's that, and then a guarantee of the level of 100% could, in many of the contexts and the fiscal constraints that many emerging markets are facing, might simply become difficult to afford for many lower income markets. One last point on the guarantee aspect. Puzzling result from our data is that within countries, it does look like it's a minority of financial institutions that ultimately were able to leverage the guarantee programs where they existed. So not all markets are able to spread the guarantees across the entire financial sector and might be using public banks or have limited eligibility for financial institutions to actually leverage these instruments. Thank you.
Thank you.
Thank you very much for your responses to the comment made by Professor Yoshino and Harada-san. We received several questions from our viewers. Let me read actually those questions all together and ask our speakers to respond. And then I'll also ask Professor Yoshino and Harada-san to come in if you have also additional comment from your end. First question, thank you very much for your presentation. How do you see the efficiency of the G20 and Paris Club Common Framework after the DSSI? Do you have any ideas what would be the better way to coordinate the debt restructuring for the lower and middle income countries, such as Sri Lanka, which is out of the scope of the common framework? This is the first question. Second question that we received. In the case of Japan, I wonder that may be difficult for zombie companies to go bankrupt because medical and social security systems are based on the employment and household. Then I would like to know how the financial recovery collaborate with the other legal and administrative system. This was the second question that we received. Third question, how can an opaque debt track be specifically monitored? Won't digital technology make it even more difficult? So this is the first three questions that we received. We received more questions, but let me ask Leora to respond to those points. Perhaps Mahesh and Ben can also come in to make a comment. Leora, please.
Thank you. And we discussed in the report that the DSSI has not been as successful as hoped, the G20 efforts, in part because, as recommended in our chapter, it's the importance of governments and their creditors, the benefits of improvements in sovereign debt transparency of ultimate holders of debt, and the importance of the governments in debt distress to coordinate with their creditors to restructure their debt directly. And we also, walk through a number of steps that countries can take proactively, including reprofiling their debt to reduce interest rates at this time. All interest rates are still lower. But the short answer is that the lack of take up by the SSI does suggest that we do need alternative frameworks to address the growing sovereign debt distress.
Yeah. So on the second question, it's not more difficult, certainly, than it is in other advanced economies for zombie companies to go bankrupt in Japan. Now, it was made more difficult over the last couple of years, and we surveyed 65 countries, including Japan, and found that in 80% of these surveyed countries, there were temporary measures enacted during the COVID crisis to make it more difficult for a zombie firm to go bankrupt. And these range from outright closing of the courts to making it more difficult for debtors or for creditors to enforce their rights, to limiting the conditions under which creditors could put a company into bankruptcy. But the Social Security claims, for example, in Japan, don't rank measurably higher than they do in most other advanced economies, and wouldn't be a prohibition on engaging in the bankruptcy process. Now, as a practical matter, employees are often harmed by the failure or bankruptcy of a company, and this may have implications on medical insurance. And I'm not sure to the extent that that's true in Japan. It certainly is true in the United States, but it's not a prohibition or a prevention against those companies going bankrupt. It's rather a collateral impact on the employees. And overall, I suppose in the second part of this question, the recovery mechanism in Japan shares a lot of similarities with recovery mechanisms in most advanced economies, in that it provides for both in-court and out-of-court resolution. It provides both for creditor-led liquidations and court-led liquidations, and generally follows a scheme of priorities that privileges secured creditors first, and then has, as we call it, a waterfall of claims or order of priority that shares similarities with most advanced economies.
Thank you very much. Ben, any additional comment from your side?
No, thank you.
All right, thank you very much. Yoshino Sensei, if you have any comment on those questions, please.
Thank you very much. A very important point about zombie farms. I differentiated two kinds of SMEs. One is temporarily affected, another one is structural problem. And one of the ways is to look at their balance sheet. If MSMEs are establishing good balance sheet, then we can look at whether their sales and profits are continuously negative or they are temporarily negative. That is one of the ways. And as all of you have pointed out, 100% credit guarantee will create moral hazard program. And that should be a partial guarantee would be much, much better. And I agree. But the Japanese politicians put 100% guarantee in this crisis. And thank you very much.
Thank you very much. Harada-san, any comment from your side, please?
Not this moment, thank you.
Thank you very much. We received several more questions. Let me read those questions, asking Leora and the team to respond. First question, how do you monitor the attitude of financial institutions? For example, civil society has pointed out that Japanese banks and insurance companies have such a bad attitude that there is no better alternatives, even if they want to divestment from the wrong perform financial companies. There is also strong opposition to the hard rolling of the business and human rights principles by private sector, even they express the commitment. Its daily attitude has a huge gap. That's the first comment made by the anonymous participant. Second question, do you have any other ideas for access other than digital technology like mobile finance to informal sectors in developing countries? So if you have any response, Leora, please. Thank you.
Thank you. Let me also, to address these questions plus the earlier question on what is the role of digital finance to address transparency, right? So to answer all these questions, yes, certainly fintech competition can introduce innovation, alternatives to a market. And so just to clarify what Benny was discussing earlier, that given the uncertainty that was created by COVID and really continues about real sector performance, especially industries like tourism, like other service industries, what we call embedded contextual finance can offer is real credit in response to real economic activity. So for example, take the case of supply chain financing, which is conditional on receivables. And so it's only after goods or services are delivered and an invoice is created, a receivable is created, that the bank will lend against. So it's a way of monitoring real economic activity or think about, in the case of supply chain finance, so you have greater visibility into the firm's economic activity, and you have greater recourse in the case of non-payment, or in the case of embedded finance, great reduction in the risk of non-repayment, because in the case, for example, of supply chain finance, the payment to the lender is made directly from the buyer. Or think, for example, in the case of e-commerce, again, for lenders to have greater digitization, leveraging digitization, the technology, lenders can actually have greater visibility into the sales that are done online, lend against those sales. And again, in the case of e-commerce platforms, various innovation is allowing the lender, again, to be paid directly from the platform, circumventing the seller to reduce the risks of non-repayment.
Thank you very much. Yes, please.
Perhaps if I can add on the last question on digital technology. So first of all, in the WDR, we try to be more nuanced than maybe we came across, that I came across in my presentation, and making sure that we don't, it's not all about digital technology or digital channels that can help in terms of addressing some of the challenges that currently lenders face in reaching MSMEs. There are product designs like the ones that Leora described, but even a common reaction that is done in order to increase visibility is actually to shorten loan tenures. That's a form of credit tightening, but it is, and this one we also see from the data, it is one of the more common ways in which lenders react in a situation of heightened risk. Now, reaching the informal sector, as this question phrases, is and will continue to remain a challenge. Digital finance can certainly put a dent into that, but lending to MSMEs is harder because MSMEs tend to be riskier. They're typically less visible, but they're also more expensive to reach and to assess in terms of their credit, their viability as borrowers. So that and informality will continue to remain a very significant challenge to that. Maybe the last plug, and the work on credit infrastructure, which doesn't have to be based on digital channels and digital technology, can go a long way in terms of improving lending for MSMEs, although maybe not necessarily reaching all the way through the informal sector, although Mahesh may correct me here.
I think it's important to note as well that some of the platform lending, mobile platform lending for in the informal sectors is showing evidence of having higher levels of over-indebtedness of those firms and entrepreneurs and higher NPL rates, which suggests that the risk profile isn't changing by the introduction of the digital technology. It is becoming somewhat less expensive to originate the loan, but it may be exposing some of those borrowers to predatory lending behaviors as well. So I think the message is complex. I think the digital technology provides a way of driving down costs and a solution, but it's not without its challenges.
No, thank you. And that also in relation to the question around trust in financial institutions, we know trust is highly related to consumer protection, to fraud, and as Mahesh mentioned, the growth of especially algorithmic digital credit creates tremendous opportunity. It requires a strong regulatory and supervisory framework that both allows for innovation. However, you're protecting consumers against inappropriate behavior, as well as preventing misleading, incomplete information being provided to borrowers.
Thank you very much. You responded to the question that we received from viewers in a very effective and efficient manner. So before wrapping up our seminar, I would like to ask each one of you to make the very final remarks, perhaps asking in the reverse order of the appearance, starting with Harada-san. And then I'll ask Yoshino sensei, and then I'll ask Beniamino and Mahesh, and then Leora to make the final remarks. So Harada-san, please, if you have any final remarks. Thank you.
Okay, thank you. I was glad to be a part of this event, and my comments are mainly for sovereign side. So I don't know whether it really fits to the main part of this presentation, but anyway, I think the report mentioned a lot of important things, and that World Bank mentioning those issues like financial sector risks in this flagship report would be very important. So we hope that we work together for this important recovery process. Thank you very much.
Thank you very much, Harada-san. Professor Yoshino, please.
Okay, thank you very much for the excellent report. And I think everybody should read this report. And I have one additional comment about data of MSME, experience of Japan. About 20 years ago, we started collecting MSE database. And first one is coming from credit guarantee corporations. When they put credit guarantee, they asked SMEs to disclose their data. And they asked each SMEs to keep the book balance every day. So it's a financial education. And they started to disclose those data. And also private banks, when they are lending money, and then SMEs has to keep their books every day and disclose it. And those data has been collected at CRD, Credit Risk Database. And then we are starting to analyze noodle shop, bakery, all those small businesses. Thousands of data of each sector has been collected. Then we can identify the credit analysis of those sectors. So I think the financial education for SMEs are very important. And bookkeeping will help them to think about their own business and also their future of the businesses. So I think those kind of financial education and together with collecting to those database and analysis will be helpful in many countries. And I'm helping Vietnam and Cambodia in this matter. Thank you very much.
Thank you, Professor Yoshino, for your final remarks. I would like to ask Beniamino for making the final remarks, please.
So first of all, thank you for having us and for this interesting conversation. I think as a last message, I would just want to say that as countries look at this very complex issue, or the very complex issues that have been left to us by this pandemic, the importance of being able to put financial institutions in a place in which they can continue to provide access to finance, particularly for the SME sector, considering how important this is in most emerging market economies, is key. Doing so, leveraging some of the trust in innovation that and digitization that we've seen is also important. However, maintaining the appropriate guardrails and consumer protection and being very wary of the risks that this might also bring with it. Thank you.
Thank you very much. Mahesh, please.
So again, thank you very much for having us. I just want to take note of the fact that as we entered the pandemic in 2020, we were already at extraordinarily high levels of private sector debt, of non-financial firms, indeed higher levels than we were at the outset of the last global financial crisis. And there was an expectation that non-performing loans would rise at that point, and as would firm distress. And then, of course, the pandemic hit. And I think the question that remains for all of us is whether the pandemic has delayed that expected rise in non-performing loans, exacerbated it, or somehow allowed it to be smoothed over. And I think prudent countries, particularly emerging markets with underdeveloped frameworks for NPL resolution, would be wise to take steps to anticipate that rise and hope that it never comes. Thank you.
Thank you very much. Leora, please.
Thank you. And thank you again for arranging this wonderful opportunity to present our report and for the excellent comments and questions. As Mahesh mentioned, coming into the pandemic, it was record high levels of not only private debt, but also many countries' sovereign debt. And we hope that the World Development Report encourages policymakers to prioritize this need to ensure sustainable private and public debt burdens so that households and businesses can maintain access to financial services that offer them the financial resilience and allows them to invest in the recovery. So thank you.
Thank you very much. With us from Washington this morning, we had Leora Klapper, Director of WDR 2022, Beniamino, Savonitto, the Economist from the International Finance Corporation, Mahesh Uttamchandani, the Practice Manager for Finance, Inclusion and Infrastructure of the World Bank. And Tokyo side, we had the Professor Naoyuki Yoshino, Professor Emeritus of Keio University and Director of the Financial Research Center at the Financial Services Agency of Japan. And Tetsuya Harada, Executive Senior Research Fellow on behalf of the JICA Ogata Research Institute for Peace and Development. Thank you very much, everyone, for joining us this morning. Really appreciate it. Please check the update information on the online events by the JICA Ogata Research Institute on JICA website, and events are organized by the World Bank on the World Bank Tokyo office website. We have lots of interesting event coming up for you. And also later we'll post the PowerPoint of the speakers and commentators all together. And I understand that the recording of the seminar also will be posted on the website later. So with that, I would like to say once again, thank you everyone for joining us. Stay safe, stay healthy. See you next time. Thank you very much.
Thank you.
Thank you.